Okay, I guess that's me. I'm up.
No, not yet.
Okay, all right.
But I'm so happy that you're so
Okay.
ready and eager.
Yeah, yeah.
Awesome. Well, good afternoon, everyone. Welcome to the BC Links to Learning with Cando. Um, Financial literacy. That's what we're going to talk about. Our presenter Raymond is going to fill us in with some good tips and information, really necessary information, I think. And for some of us, it might be a refresher, a good reminder. So we welcome you. Thank you for joining us here in Amisquitchie, Waskagan. So in Edmonton, Treaty 6, the sun is shining this morning. This morning's Links to Learning, it was pretty overcast. So really happy that sun, that PSIM is out. So we first of all just want to give thanks to Creator for the gift of another day, a gift of another opportunity just to learn and to have this virtual connection. It's been almost a full year that we've been in this pandemic, but we've learned to really find connection through Zoom and through modern technology. So we just give thanks for this opportunity and for this moment. Really honored that you're here. I hope wherever you are, wherever you're joining, listening from, I hope that you are well. I hope that you feel healthy. I hope that you feel happy. And I hope that you're just at peace with where you are. So welcome. A couple of things throughout. If you have any questions, please use that chat box. There will be opportunity for questions and even discussion and comments at the end. But if you have a pressing question throughout this presentation, use that chat box. I will definitely make note of it and we will definitely come back to it. There also will be an evaluation link sent to you, and we would love to hear your feedback from today's presentation. So when you fill that out, your name will be entered to win a draw. So I believe it's a 400, there's two of them this week, a $400 Visa gift card. Like, check that out. So really in your best interest, and it helps us, it helps Cando when we hear your voice, when we hear your feedback. So fill that evaluation out, please, and thank you. So I'm going to just introduce quickly Monica, and then she's going to pass it over to Raymond. Monica is with the Business Development Canada. So today's workshop is Understanding Financial Statements. So covering the basics around the terms and concepts of financial statements, review and understand, be able to ask informed questions of financial professionals, asking the question, how is your business doing? Did we make money this year? How does my P&L, or what does my P&L tell me? Why do I need a balance sheet? Where's my cash coming from? Where's my cash going? Why isn't my cash equal to my profit? So covering some good ground here. So we're really, we're ready to learn. We're ready to listen. So welcome, Monica and Raymond. Oh, you're going to have to unmute yourself, Monica.
Okay, thank you for that. Start again. My name is Monica James. I'm calling you today from the Treaty 1 territory and the homeland of the Métis Nation in Winnipeg, Manitoba. I was actually born and raised in the northern Manitoba, and I'm a proud Cree woman from the Peter Ballantyne Cree Nation, northern Saskatchewan. So working in a remote community, I understand that the strength of a community, and also being Indigenous, there's a lot of things that we face that other demographic groups don't face. So I've been with the Business Development Bank of Canada for 18 years, and for 18 years, my passion has always been to raise up my people and represent them nationally at my company. And so I was actually founding member of the Aboriginal Chamber of Commerce in 2004, and I've always driven to making sure that we're succeeding when it comes to helping our Indigenous people. So I'm really excited because the partnership that we have with Cando and CPAC Canada around financial literacy is so important. So BDC and NACA ended up doing a joint research project in 2017. And one of the big things that actually came out of this research facing Indigenous entrepreneurs is the lack of financial literacy training. So hence why this was born, because this is what the research told us. And this is what we need to be doing, is getting that information out there to you, the people. And so I want to hand it over to Raymond now, who is going to be our great presenter, and good luck with everything.
Thank you, Monica. So my name's Raymond. I've been doing these financial literacy sessions with CPA Canada for the last 3 or 4 years now. My background is in audit and tax. I've lectured on finance and fundamental analysis, and of course, I'm a CPA. So when they talk about financial literacy, and I heard Monica say something about, it's so important in the First Nations community, but honestly, I think it's important in every community. And the lack of financial literacy just across Canada is, it's tough. It's tough. It makes people's lives tougher. And I've been doing sessions on personal finance and all the way up to, helping business owners and entrepreneurs in this case, and economic development officers. So this work, the ability for you all to relay the importance of this information and actually convey how, I was talking to Michelle earlier and I said, this presentation is dry. It's also technical. And unfortunately, that's the nature of business at the end of the day. Everyone has this idea that it's going to be this passionate hustle, and you go out there and sell products and do whatever and meet people, and that's part of it. But at the end of the day, the business owners with the lowest risk profile, who are actually very successful, are the ones who know how to sit at their computer at the end of the day and log what is actually happening within the business. And accounting is the language of business, right? So that's what we're going to go about trying to explain today. And I'm going to get right into it. Before I do that, does anyone, in terms of what you guys want to get out of it or any specific questions you have, feel free to just kind of state them in the chat. I'm going to pop open the chat here and just say hello. There we go. So yeah, so feel free to, we can communicate either that way or just ask questions as we go through this. And what I will also do is I'm going to share my screen like that. All right, so I'm going to go kind of not in the order of the presentation just to start with. And I'm going to go, so the handouts that you all have, can I move this? Yes, I can. All right, perfect. The handouts that you all have include this PDF, which is the presentation. So you can go through it as I go through it. The glossary of terms, I would suggest, opening multiple windows on your computer if you can. The glossary of terms kind of just goes over the technical definitions of the terms that I'll be going over. The implementation checklist, this basically has to do with what business owners need to look at when they're at the end of the month or end of their quarter, or bi-weekly. And then this, I think I put a little note here. And once we get to the slide, we'll go over the difference between the statements on this PDF and on this slide. And then the last one I had over here was the, you guys telling them how well or not so well I did this presentation, but I'm gonna leave that to you guys. So let's start the presentation. I've already introduced myself. And it really is a pleasure to doing this. This is kind of the feel-good piece of my day. So we have about an hour or so, and we burned through 10 minutes of it. So we'll go fairly quickly through this. And the session is designed to be interactive. So as I said earlier, please feel free to speak up. As they talked about earlier, this session is presented by CPA Canada, and it stands for the Chartered Professional Accountants. And they accountants pretty much work with numbers to help keep a business honest and successful. And CPA Canada is one of the largest accounting organizations in the world, representing more than 210,000 CPAs across the country. So some work in accounting firms, others in industries across the board, right? Entertainment, sports, tech, whatever. And depending on their specific jobs, CPAs can be responsible to make sure a business's financials add up, manage their budgets, and develop plans and policies to help them grow. So let's get started. So common questions that business owners ask, right? So how is the business doing, right? And that's a very general question, and has, in terms of the answers to it, like we're going to talk about fundamentally on the numbers basis. Okay, there's the whole operations side and the HR side and all of that. We're not touching any of that stuff. Did we make money this year? So later when we go into the financial statements, we'll talk about income versus cash flow and what those differences are. What does my profit and loss statement tell me? Why do I need a balance sheet, right? Because that has to do with assets and liabilities on the back end. And the other piece is, where is my cash coming from? Where is it going? And why isn't my cash equal to my profit? So that's, cash flow versus income, right? Next. All right. So 3 main financial statements. So one of the common problems that many people experience in understanding finance is that the same statement or element can have multiple names. And those names are often interchangeable by financial professionals. So to a non-financial professional, and we're going to try to do this in layman's terms, but really what this presentation is about is translating technical terms to the layman. So we have to kind of do it in a technical way. So as I was saying, having these multiple names can be confusing and frustrating. And this slide lists several of the alternative names. For example, is profit and loss. So it's also called income statement or earnings statement or statement of comprehensive income. And each of these things, they refer to the same statement, right? Then the other alternative is alternative names for the cash flow statement. So sources and uses. So that, what's happening with the cash? Where is it coming in from? How is it being used? And statement of changes in financial position. It should be stressed that both of these names, they refer to the same statement. And last, this slide lists the alternative names for the balance sheet, which is the statement of financial position. Okay, so primary categories. Oh, sorry, next. So understanding the P&L, the profit and loss statement. So we're going to introduce this concept and offer kind of a brief explanation of how profits and cash differ. So the first bullet says it compares revenue and expenses, right? And it also provides the formula, which is revenue minus expenses equals profit. Now, profit and loss statements are prepared according to accounting rules that require revenue to be recognized when the sale takes place. This is key. So in many instances, this is before the cash is actually received. So revenue is being recognized before cash is being received. For an example of this is like a customer paying for an airline ticket in advance, but does not take the flight until 2 months later, right? Accounting rules also require that expenses may be recognized when they are incurred, which may be before or after the cash is actually paid. So generally speaking, businesses like to, you'll see these in like your accounting, in your sales invoices, where it's like net 30, right? It's like, we'll sell it now, but it's due within the next 30 days. So they have to recognize the sale because it's done, right? And maybe the goods have already been shipped or they're on their way, but they're not going to get paid for the next 30 days. So that's going to be the difference between recognizing income and recognizing cash. So the same thing that also requires, as I said, that expense be recognized when they're incurred. So which may be after or before the cash is actually paid out. So one of the examples of expenses being accounted for before cash is paid is when a company orders catering for all its staff. So they'll eat all the food and the bill will only be paid when it's invoiced. So basically, the expense is being accounted for after the cash is paid. So they've prepaid, right? And the same thing they also talk about here is if a company prepays rent, right? So if you've prepaid rent for the next couple of years, well, the cash is out, but the expense is going to get recognized as that month goes by, right? So when accounting rules are being used, a business is said to be using accrual accounting, right? So with this, you can look at the definitions section. So for example, here, let me just get into it. Where are you? Accrual accounting, right? So I don't know if I should go into it with you guys, but basically this is exactly what we were talking about, right? So when expenses are accounted for when the goods are being received or when services have been used. So this is the difference between like when it's being paid or when it's being used or received. And as I said here, irrespective of when cash is exchanged, right? So this as an example has an effect, for example. So if there is a delay when a customer receives a service and pays their bill, or when the business pays its bill and later receives a service. So one of the key things here that generally happens is customers want to pay as late as possible, and so do businesses, right? And it affects them both profoundly. So it affects cash flow on both sides. Next one. So sorry, give me a second. Did I miss anything on this one? No. We're good. Okay. So when a business uses accrual accounting, accounting events and cash events are recognized at different times, right? So that's why we're going to go over this over and over again. There's a difference between profit and the cash in and cash out. Okay, so examining the profit and loss statement. So the purpose of this side is to identify the basic categories of revenue and expenses that appear on the P&L. These categories are important because there are different ways to evaluate the different sections of the profit and loss statement. As you can see here on this slide, there are three primary categories of revenue and expenses. So the top one is sales activities, right? And it's revenue and expenses associated with, and an example is like selling to a customer, right? Operating activities is expenses of operating the business, and non-operating revenues and expenses, which include things like interest, income tax, and one-time unique income and expense events, such as like a sale of an asset, like a building, right? Or a large write-down of inventory. Say you had spoiled inventory that you can no longer sell, so you have to just write it down. So those kind of occur in non-operating. So normally, like an example here, so revenue and expenses in sales activities, say you're selling, I don't know, potatoes, right? And you can list the revenue in the sales in revenue, and the expenses would be the cost of buying them, right? But say you had this huge write-down of it. Potatoes is a kind of a bad example over here, but say you had a huge write-down of this, well, that's where you would have that one-time write-down. Okay, so examining the profit and loss. Examining the profit and loss statement. So now we're looking at sales activities. And within that, we look at revenue, cost of goods sold, and gross profit. So those are the three items. So sales activities of the business include the revenue a business generates for selling products or services, as well as the cost of purchasing, creating, or providing that service. So the profit of a business that it earns from these sales is known as the gross profit. And it's calculated by simply subtracting out the cost of sales from revenue. Sample sales activities for this is shown. And in this example, as you can see, it's really straightforward. 100K in sales, 36K cost of goods sold. So your gross profit is 64. Gross profit in terms of like, terminology, it's sometimes also known as gross margin. And the margin is just the difference, right? Between your revenue and your cost of goods sold. Unfortunately, like this is a virtual thing, but normally to illustrate this point, we just kind of pick a company that, you know, someone's familiar with, right? And you can do anything. And these are straightforward back of the napkin kind of calculations. You can do it with anything like a restaurant, a bar, whatever. You basically look at how much what's the sales price? What's the cost of that item? It includes, you know, all costs associated with getting that item ready for sale. And what's the difference? That's your gross margin. Okay. Examining the profit and loss statement, operating activities. So operating expenses are the costs of operating the business that are not directly associated with products or services being sold. So operating expenses include selling expenses, R&D, general and admin, as well as depreciation. So examples of these expenses include marketing, advertising campaigns, right? Marketing or advertising campaigns, rent and utilities. So that's like your general and admin, as well as corporate overhead costs, such as the president's salary and the human resources departments. So, so in terms of relevant costs for like R&D, sometimes what shows up in that is like design costs. So your example is like company selling snowshoes. So the R&D would be the design that goes behind selling something that's lighter and smaller or something like that, right? The sample profit and loss statement shows the business's operating profit. So the operating profit is calculated by deducting the total operating expenses from the gross profit, right? So you see the previous slide, we showed the gross profit, just revenue minus cost of goods sold. Then you take out the operating expenses and then you get your operating profit of the business. So in our example, as we talked about earlier, this business has 44,000 or 44K in operating expenses. So their operating profit is 20,000. So on $100,000 of revenue, right, their ending operating profit is 20,000, right? A lot of the times, like one of the things to note, right, is a lot of these costs, operating costs, depending on how they go, generally scale with the business. So often as these revenues and these costs go up, these operating expenses can also increase. So in terms of when you look at these business owners, what they're trying to do is they're trying to increase these revenues. This cost of goods sold is very closely tied to revenue. But these operating expenses, after they reach a certain size, then they can actually try to keep those lower while these continue to grow. So this is like kind of the things that business owners need to be aware of and try to improve the, you know, outcomes of their business. Okay, examining the profit and loss statement. The example on this slide tells us how much the business made this year. Okay, so non-operating activities. So this is, now we're looking at the whole thing, the net profit, right? To determine how much the business made this year, non-operating expenses should be deducted from the operating profit. So you see here, operating profit right at the bottom, and non-operating income should be added in. So non-operating activities include interest payments, income tax payments, as well as other one-time non-recurring items, such as profit or loss from the sale of an asset. So as I said earlier, like, you know, if they sell a business or a big piece of equipment where their business isn't selling equipment, it's just a piece of equipment they use, right? So those are also included here, these one-time major issues, and they also talk about write-downs of inventory. The bottom line on the profit and loss statement is known as the net profit, and it's also known as net income, and very often referred to as the bottom line. So what's your bottom line? When you hear that phrase, it refers to this bottom line for accountants. And you know, so we talk when we talk, like, you know, casually, like the layman's term is, you look for top line growth, that's revenue growth, And what's the bottom line after the end of all of these things kind of get deducted out? So what we're aiming here is for companies to increase their top line growth, as well as improve the bottom lines for their business. In our example, what you see here is we deduct 4,000 of interest payments, 6,000 of income tax. Now you have a net profit of $10,000. So on 100K, they make 10, right? The business owner makes 10. Okay, so understanding the balance sheet. So now we've done income, right? So we looked at revenue, cost of goods, so you get gross. Let me just go back one. I just want to touch this. So revenue, cost of goods, gross profit. Take out operating expenses, you get operating profit. Then you take out all these non-operating ones, net profit, right? So this statement's done. So that's your income statement. So there's 2 left to go. So now we're looking at balance sheet, and then the last one will be cash. You have a question, Cindy? You're on mute. Okay.
Yes, looking at that
Yeah.
chart there, profit and loss statement. If I start out with $100,000 and purchase a product, and then to sell the product, I'm doing some designs and advertising and stuff. And at the end of all of that, the interest and the income tax for the year, I'm only making $10,000 out of that $100,000 that I just invested.
No, so that 100,000 over here is not your investment. That 100,000 is revenue. So that's from sales. So that's the sales income. So the costs are these ones. So the cost of goods sold. So say, I don't know, let's say this guy was selling water bottles, right? So the 100,000 is from the sales of the water bottles. The 36 is how much it cost him to buy all the water bottles. That's the cost of the goods that he sold, right? And then the operating and non-operating are all the other stuff, all the other expenses that are I wouldn't say associated, but that they also incur during the year to run the business, basically. So you were talking about like marketing, for example, right? So marketing goes under this R&D budget. Sorry, not marketing. The design would go under R&D budget. Marketing could go under selling expenses, right? So maybe they're paying a sales guy, maybe they're running some Facebook ads or whatever it is, right? And especially with marketing, companies need to be very careful with how they spend. It's very easy to spend a lot on these kind of issues, and they don't always relate to increasing their top line growth that could significantly affect the bottom line, right? So for example, if they just, let me go back. So say these selling expenses here, say he just increased it by $10,000, right? He'd end up with nothing at the end of the year, right? So these are the kind of things. And, you know, a lot of business owners, especially like new budding entrepreneurs, they get so excited by this revenue number at the top that they forget to drill down to make sure what all these expenses associated with are. And then at the end of the year, they look at themselves and they go, wow, you know, first quarter I sold like 10,000. Second quarter it was like 30. Third quarter it was 60. Why do I still not have any cash at the end of the year? Right? So that's why all this cost management stuff is so important. And the only way to do it really is to account for it carefully, right? And check it at the end of every month so that, yes, everybody's real happy when they're making sales, but do those sales result in a gross profit, an operating profit, and a net profit for your company? Because I wouldn't say for business, especially businesses where like the income is like holding together the household, right? Having an operating profit and a net profit at the end of the year or month is really important, right? So that's kind of what we're getting at over here. Did I answer your question, Cindy?
Yes, thank you.
Okay, cool. All right, so the balance sheet. So the balance sheet can be thought of as a list of what the business owns and what it owes. It owns assets such as cash, accounts receivable, or money owed to its customers, inventory, as well as plant, property, and equipment, right? So basically assets are anything of value that the business owns. Liabilities are a category of what the business owes. So there's owning versus owing, right? So they generally consist of money owed to vendors. So this is what we're talking about, right? Like, so when you buy something, so the water bottle example, right? When they bought the water bottles, maybe they didn't pay the cash right away. Maybe the terms were, we'll pay you in 30 days or 60 days or whatever. So that would be a liability. That's what they owe to a vendor. As well as money owed to lenders. So say they borrowed from a bank or something like that, right? So we have BDC in the house over here, right? So that's what the liability would show up. So the bank loan would show up as the liability. And finally, the owner's equity is the other category of what the business owes. And basically this consists of either the money that the owners have themselves invested in the business, or the profits that the business has earned that have not been paid out to the owners, right? So a lot of these businesses for the first couple of years, they won't pay out profits. They don't pay out dividends. They just kind of keep it in the business. And that's where it would show up. And when the balance sheet is prepared, assets must equal the liabilities plus the owner's equity. So that's how it balances, right? So this side will balance with this side. This statement simply means that when a business acquires an asset, it had to have a source of money to obtain that asset. And this money either had to be borrowed or had to be contributed by the owners. That's basically it. Do you have any questions? No, okay, I'm gonna continue. Okay, so understanding the balance sheet. The profits and loss statement shows the profits of the business over some time period. So it could be a month, it could be a year, it could be a quarter or 3 months, right? The balance sheet, however, shows the assets and liabilities of the business at a single point in time, right? So profit and loss and income is over a period, right? It's like how much revenue is being generated, how much is being spent. But the balance sheet, because these are actual amounts of like a plant or something owed, it shows on that date, what did they own? What did they owe, right? And you can use a month end or year end. So under accounting rules, the assets and liabilities on the balance sheet are carried at historical value. So that means like whatever it was initially came onto the sheet as, that's where it stays. This means that assets are carried at the cost of acquisition minus any depreciation. While correct from an accounting perspective, using historical value means that the values of assets and liabilities on the balance sheet may be different than what the actual market value is. For instance, the market value of real estate might have appreciated significantly from its historical cost, while the market value of a used computer, for example, might be substantially less than what it is on the accounting value. This is where things like depreciation comes in, and we'll get into that. Intangible assets are non-physical items, such as patents, trademark, and brand name. And only some intangible assets are recorded in the financial statements, typically those acquired. Others, like internally generated brand name recognition, also kind of referred to as customer loyalty or employee morale, they're often just not recorded at all, right? So these kind of issues show up when people are trying to value businesses and things like that. So we'll just quickly touch on depreciation. So this slide describes depreciation as a non-cash operating expense that allows businesses to deduct the value of periodic wear and tear on its equipment, right? So each year, the value is depreciated by whatever amount to reflect that. And it shows, basically what it shows is the historical cost of the asset minus the total depreciation over that time period to date of the statement. Yeah, and the profit and loss statement will show that annual depreciation as an expense, right? So it'll get expensed on the P&L, and the balance sheet will have the total depreciation over time to adjust that cost. Okay, so examining the balance sheet. So the asset section of the balance sheet is typically divided into current assets and fixed assets. So current assets are assets that are currently in cash, or they can reasonably expected to be converted into cash within a year. Fixed assets refer to things that are not typically converted to cash. So plant, property, and equipment are one of those, right? Current assets over here are cash, inventory, accounts receivable. As you can see, all of those things can be quickly converted to cash. Should be. Accounts receivable is one of those issues that businesses have, and we can talk about that a little bit later. So on the right hand of the screen, you see an example of a balance sheet. In our example, the business has $25,000 in cash, $20,000 in inventory, and $10,000 in accounts receivable. So accounts receivable is basically they have sold something to someone and now they're just waiting on them to pay. That's what that is, right? So it shows up as an asset and now you're waiting on that client. So for businesses, controlling that accounts receivable is really important, right? And especially when you have clients that don't pay and all that stuff, right? So there's risk management activities that come in, and we'll talk about later. This can significantly affect their cash flow. Now the total current assets, as you see here, are $55,000. Fixed assets include the plant, property, and equipment, minus $5,000 in depreciation. So basically, they paid $50,000 for it, and this $5,000 reflects like the wear and tear or whatever, how that plant, property, and equipment has been diminished, right? So in total, the business has 55 plus 45, 100,000 in assets. Questions, comments? Everyone good? Okay. Okay, so now we're going to go to the liability section. So we talked about earlier, 3 sections, right? Assets, liabilities, owner's equity, right? So the liability section is divided into current liabilities and long-term liabilities. So very similar to assets, current and fixed, right? Plant, property, equipment. Liabilities, current and long-term. Current liabilities are those that need to be paid within 1 year, same concept, while long-term liabilities are due a little further in the future. So an example of current liabilities include accounts payable, money that a business owes to suppliers or vendors, as well as loans that must be paid within 1 year. So long-term liabilities includes loans that must be paid at some time in the future. So bonds and loans payable, like long-term loans, right? In our example, the business has $30,000 in accounts payable and $5,000 worth of loans that must be repaid within the next year. So the current liabilities, as you see here, are $35,000. Additionally, there's $25,000, a $25,000 bank loan over here that must be repaid in future years. So the total is this 35 plus this 25 gives you 60. Okay, so this basically, the liabilities portion shows what the business is liable for, what they owe. And lastly is the owner's equity section. And this shows the value of the owner's investment in the business. So it could include the initial money put up by the founders of the business, as well as additional investments from other investors or for the sale of stock. Okay, so owner's equity may also be called shareholders' equity because they own, right? Proprietors' capital, partners' capital, or other items. So it's basically capital that comes from the owners of the business, right? So owner's equity is not the value of the business. It's just that's not that. This has nothing to do with business valuation. Okay. As mentioned above, basically, yeah. So basically, all it talks about is money put up by the founders of the business and additional investments from investors or from sale of stock, which are basically investors, right? The terminology will vary depending on whether the financial statements represent an unincorporated business, an incorporated business, or a not-for-profit. That's why you have all these, partners' capital is maybe an unincorporated business, or maybe it's like an LLC for like a law firm, things like that. The owner's equity section of the balance sheet also includes an entry known as retained earnings. And this is somewhat confusing outside of financial circles. Now, retained earnings basically are created via an accounting entry. And what they do is this amount includes the cumulative profit of the business since inception that have not been paid out to the owners as dividends. So the concept is simple. So basically, if a business makes a profit, the profit is either paid out to the owners as dividends or it's left in the business and used to help it grow. When it's left in the business, it's categorized as retained earnings. So at the end of the year, whatever profit that is not paid out to the owners as dividends goes to retained earnings, right? And then you start the income statement again the next year. So think of retained earnings as an accounting entry reflecting the funds or the profits that the owners have reinvested in the business instead of paying themselves out as dividends. So in our example, the business has capital stock of 30,000, retained earnings of 10. So they have chose not to get paid out. They've left the money in the business to kind of help run things. So the total owners have equity of 40,000. So now this slide, the complete balance sheet, presents an example of a complete balance sheet for XYZ Corp. As of, so we talked about balance sheet is at a point of time. So it's as of that date. So note that the assets are shown on the left side and the liabilities and owner's equity on the right side. The two sides balance. So you see 100K here, 100K here. And that's about it. Okay.
Do you have a question?
Do we have a question?
She's waving her hand.
Oh, sorry. Hi, go ahead, Sydney.
Sheet before this,
Yeah, go on.
I was just go to the sheet before this one. Yes, okay.
So sorry, this one, this sheet right here?
Yes, yes.
Okay.
So if you retain your earnings and something happens to the business and your partner is in there, do they still get the share of your retained earnings if the business should fail?
Right. That's how I don't want to get too deep into this, but that's how the equity portion works. So the retained earnings get split by all the partners according to their ownership stake, right? And if the business fails, often there's really nothing left in there, right? It ends up going to pay off whatever, right? And then eventually what happens, if there is stuff left, is you end up flipping out the assets, right? So you sell all the assets, you pay down all your liabilities, and whatever's left is sitting in here, right? And it gets paid out accordingly. If it should all work out, right? And the reason I say it's a little bit different is because going back here, you're talking about business failing, right? So these assets here that get sold, that's when you figure out what the market rates are, right? We were talking about historical value and depreciation and stuff. Once the business fails, then you figure out what the market value of, you know, everything that you purchased and all of that, so that you can actually, you know, liquidate everything and then figure out, because we were talking about fixed assets being long-term, right? So that's the point you get to. But if you're talking a business with no assets, essentially, yeah, there's a split at the end. Good. Okay. Okay, understanding the cash flow statement. So we have about 15 minutes left, so I'm going to kind of whip through this fairly quickly. So cash flow, as we all know, is really important to a business. Without a business really requires cash to pay for its expenses, and without sufficient cash flow, lots of businesses fail, right? So the role of the cash flow statement is to show a business where its cash comes from and where it goes. It shows the cash received during the period as well as the cash that's paid. The cash flow statement illustrates cash on hand. And give me one sec. At the beginning of the period, right? So cash at the beginning of the period. It looks at cash inflows and outflows. So basically what's received and what's paid. And the ending cash balance at the end of the period. It's good for a company to have more cash than it started with. Pretty obvious. And it's bad if the cash balance is negative. So the cash flow is sometimes called the sources and uses statement. So operating cash flow, financing, and asset activity cash flow. A business can obtain cash from multiple sources. So these include the operations. Ideally, this is where most of the cash comes from. Operating cash flow comes from the sale of products and services. In contrast, financing and asset activity cash flow comes from lenders, investors, and purchase and sale of assets. Okay. So for example, if a company raises money, right? So the investors will come in with a stock purchase or whatever, that would show up here. And these financing and asset activity can be thought of as infrequent activities, as opposed to operating cash flow, which should be a frequent or more frequent activity. Financing and asset activities, these are non-recurring, which they don't keep happening all the time. They may, if a company keeps raising funds, but it's not recurring like on a monthly basis, right? Cash received. A business receives cash from both its operating and from its financing and asset activity. Operating activity cash flow is the recurring cash flow that keeps the business alive, essentially. This includes cash sales, credit sales, and debit sales, as well as customer payments, right? Financing and asset activities. Now, what we're looking at, these are infrequent activities, right? But they generate cash. For instance, a business might take on a loan to purchase a piece of equipment. The loan proceeds would show as a financing activity. And likewise, a business might sell some of its assets, such as like a used dump truck or something, and receive cash from the sale of that asset. So your asset sales is zero, but if they sold something, it would show up over here. Sample cash flow statement shows 90,000 in cash, right? Generated from operations, so cash, credit, customer payments. And an additional 45,000 were generated from a loan and owner's investment, right? So the total cash receipts over here is 135, right? So, but this is from sales, and this one is just from financing and asset activity. So selling assets and raising money for the business. And in this case, it's a loan, right? So the ways to loan, to raise money are either you get a loan or you sell part of the business, right? So that's when your investors come in. All right, examining the cash flow, cash paid. Let's continue. So when a business is operating, it needs to pay its suppliers, workers, and other operating expenses. In our example, the business pays out 75,000. We also see that the business has some, so the 75,000 that it paid in operations was inventory purchases, operating expenses, interest, and income taxes. Okay, So the business has some financing and asset activity. So in this case, 50,000 of the asset purchases. So let me just quickly go back to the previous slide. We saw that they took out a $32,000 bank loan up there, right? As well as 13K of the owner investment. So that was a total of 45,000. So on this side, we see that they spent a large, that and some of their operating income to finance this asset purchase. So that's kind of how we see what's happening, why the owner's equity is being used to finance purchase of assets. And that's why they're owed it back at the end, right? I'm going to skip the activity and I'm just going to run through the rest of it so we get to touch base on this, the rest of the cash flow statements. So now this slide presents the complete cash flow statement that we've been talking about. As you can see, it's for this period. Oh, go back. There we go. For this period. So like the profit and loss statement, the cash flow statement refers changes in cash over time. So in our example here, we see that the company started out the year with 17,000. They received $135,000 in cash, right, for the whole year. This is from operating and from financing and asset activities, right? And then what they did was they paid out a total of 127 for the same things, operating and financing activities. So they received money from the owners and from a loan, but they purchased an asset. So this came in, that went out. They received money from all these sales, but then they used it to pay for their ops and they paid for inventory and interest and taxes, right? So that's the money that went up. So what we see is the beginning, it started with 17. This is all the money that came in. So we see the total came, then they paid it all out and they ended up with 25. So that's the flow of this thing. Okay. Assume that the company didn't have any, okay. Okay, so they have an activity here, but I'll get back to it because we're kind of running short on time here. So why cash and profit are different? So we have a timing thing. So this talks about one key difference is that revenue is typically recorded when the goods are transferred or the service has been performed, irrespective of when the cash has been exchanged. The second key difference is that expenses are recorded when the service has been used or when something has been purchased. Yet the cash outflow is only recognized when the bill is actually paid, right? So that's what the difference between the income statement and the expense. So any business that does not pay the same day the service or good are received will have a difference. And ideally, most businesses should have a difference, right? They should try to pay as late as possible, and they should try to get paid as quickly as possible, right? This is basically managing your cash flow. Not all cash flow activity is reported on the profit and loss statement. For instance, the purchase and sale of assets or funds received from the owners or from lenders affect the balance sheet and the cash flow statement, but not the profit and loss statement. Financing and asset activity very often has to do with the purchase of assets used by the business, which are treated as long-term activities rather than affecting the current profits or losses. Go. Okay, so I did this in the beginning so that you guys would have something to reference as we went through. So we already kind of went through all of this stuff, but I will just pop it over. There, right? So this is what they were talking about. We already kind of went over it. This stuff right here, right? This is the synopsis, right? This is what you should be talking about with companies and entrepreneurs and things like that, right? This kind of gets right to the bottom of things without going too deep into each individual line item. And as the discussion happens, then you can kind of go through it. And it's really, really important for business owners and, you know, the organizations that you are all serving to be able to talk about this stuff intelligently. And if they can't, then it often spells out problems and risks for these companies. So having these discussions in the beginning is very difficult. And financial literacy, just on a step back and talk about it, financial literacy is just kind of like any kind of literacy. In the beginning, it's very difficult. And once you get fluent and once you've kind of obtained a certain level, then it's much easier to talk about. So the first few months or few quarters is always the toughest. And lastly, we'll do Q&A. And I'm going to leave this up while we do Q&A. This was created by CPAC Canada, copyrighted. As you can see, it's like an educational piece. And the information is believed to be accurate. No action should be taken based only on this presentation. So, talk to your own accountant. And it's available with the understanding that the publisher is not engaged in rendering legal, accounting, or other professional services. And that's it. I'm going to stop sharing my screen and you can all see me. Do we have any questions or anything else? We've got a few minutes.
I believe Michael earlier on had sent, he posted a question. So Michael, I don't know if you want me to read it or if you want to jump on and ask this question yourself.
You know what, Michelle, don't worry about it. It wasn't like, I think it's a little bit beyond what this was kind of about. This was more on like the financials basically, because I was just wondering more on with a little bit on the bigger picture with the financial statements and how they can kind of go into like what do you want to see when you're looking at the financial statements for the last 3 years, but then you're also looking at the business plan because like you're looking at like an Indigenous kind of business or community business that's doing larger infrastructure projects that can get quite technical because they have lots of land requirements, lots of infrastructure construction. That can be multi-year projects. So I was just wondering what your thoughts are on those kind of things and how to kind of advice on doing those kind of multi-year bigger project stuff. But I don't know if that's a little bit beyond that, but.
You're talking about infrastructure projects. That's interesting. Yeah, so infrastructure projects, it's difficult to correlate to your financials. Okay.
It's kind of like that. It's like that, because we have the income is based off project completion and stuff like that for construction projects.
Yeah,
so
it
has that revenue recognition difference. So
yeah, so I mean, you're trying to understand the financials and plans when you're looking at these projects, right?
Yeah, well,
so yeah, go on.
Oh, I'm just saying because like we have the business plan, right? We're looking kind of like at the construction things, but you as the kind of financial statement person, right? Like we get 3 years financials and then we get the business plan and what they forecast, but it's like, how do I tie in the financials? Because really all we look at now is like, oh, good, they have current assets, that's fine. They look financially solid with their liquidity ratios, but like we really can't, like, I don't know how to analyze that kind of like those financial statements and how they tie into looking at the business.
Well, you have to look at like what kind of infrastructure you're setting up and what's the purpose of this infrastructure and how you're managing your cash flow and your project management deliverables. So these pieces, right? Like I'm thinking about it from a project management perspective as well, because long-term infrastructure projects have milestones of deliverables, and that is closely associated with the spend on that infrastructure, right? So yeah, it's a 3-year project, but at halfway through the first year, halfway through the second year, halfway through the third year, you should actually be able to see what's happening with the infrastructure as well as what's happening with the money, and there should be a relationship, right? So this is what needs to be closely looked at when you're looking at things going over budget, right? When you're looking at, so that's how you you're going to test your contractors to make sure that, what's their stuff? Are they doing it properly? Are they delivering on these things in time, on budget, at quality, right? So this is what you're looking at. So the whole purpose of the business plan and how it's reflected in the financials is they're going to have their guidance. And as this time goes by, you need to check that they're staying within that guidance. And if there's significant variance at these points, then you need to have some serious conversations with these people, because the success of the infrastructure project is not just its ability to be executed, but to be delivered on whatever it's trying to do for the community, the business, the whatever, right? And you have to, so what we're talking here is managing the cash flow. And I don't really know if I should or want to get into a specific example, right? But it's like these kind of big boy projects are, it's very important that they are managed very carefully, because the cost overruns can not only destroy the ability of the project to be fully executed, but it could also affect the ability of the organization to get future projects, right? Does that kind of answer your question?
That's actually really, really interesting. Thanks.
Does that answer your question? Do you have anything?
No, I think that kind of answered it. I mean, like, so you're kind of saying as well, like, to do the budget variances, you're just saying, like, look at their financials year over year and see kind of like, are they kind of matching the budget that they previously mentioned? Is that what you're kind of saying?
Yeah, so that's what the business
Fun?
plan is, right? The business
Yeah,
plan
okay.
and the forecast, the budget forecast is like, it's a wish list, basically, right? It's an educated wish with some statistics to show why the bank should loan them their money and what they hope to accomplish, right? And then that, your ability to go from like a visionary to an owner of an asset is your ability to tie in the money that you're receiving and convince the bank to give it to you or whatever organization to give it to you, and then get all these people to work and do the work within the constraints of your time and money, right?
Awesome.
And it should deliver whatever the product is. This applies to everything, right? Like developing software, building a bridge, whatever, right? So that's what makes the business owner. And the only way you can really watch it is by watching the money go in, right? Watching these suppliers get paid and getting good payment terms with these guys, right? So you're watching your cash flow. Maybe your bank loan is going to come in at the end of the month, so set your payment terms for like 2 months from now. These are the kind of things that you're watching closely, and then to figure out how this thing is going to generate revenue, because whatever funds, if it wasn't a grant, if it was a loan, need to be paid back. So then you have to look at how is it going to generate revenue, and you want to get this thing doing that as quickly as possible, right? And then test that hypothesis as well. And how well has it been tested? Are these budgets reasonable? What are you comparing the budget to? Are you comparing it to other projects, similar contractors? That's how you get deep into these things.
Okay. That's actually so cool. Thank you so much for having such a detailed answer. I think I'm over-timing everybody, so I just want to make sure that everybody.
That's okay.
Thank you so much for that. That was great.
Little while, if anyone has questions, whatever, go for it.
Thank you. Yeah, we do have some people who are leaving just because of time, but
That's okay.
Ed commented, this is great. So thank you for your presentation today. There is a question. Cynthia Joseph asked, maybe Monica, this is more a question that you can answer, but she's not here anymore, but I think it's a really good question. Is there any specific training to First Nation community statements of revenue and expenditures?
I don't know. I am the messenger and not the creator. So I don't know. So I think this was organized through Carol at CPA Canada, right? So you guys can touch base with her. I did not see any when I was looking at the other stuff. And I don't know if there is a difference in, like, I don't see why there would be a difference in First Nations community statements of revenues and expenditures.
They're very different. Yeah,
they are very different. Okay, I haven't seen them.
Yeah.
So
if you're used to look at regular financial statement, when you go to look at these ones, it doesn't really. It takes a while to kind of get your head around. But I know that well, training to actually read or understand, or actually put them together, because they're audited statements, and so they would go with a firm that can do audit statements specifically for First Nations. And then to actually read them, to understand them. I don't know, like maybe the First Nations Financial Management Board, they might have something like that, some training. I can dig into a little bit, Michelle, and then maybe get back to you with an answer and then be connected.
And the one thing I will say, like I'm just kind of reading the questions, and these kind of educational courses, and even like the stuff that I've been teaching, it's really nice to listen and take these courses, but it only works in practice, you know? So as I said, and and financial literacy is a difficult practice in the beginning, right? It sucks to not know what you're doing, and it takes far too long. And when you sit beside someone who really knows what they're doing, what took you all day will take them 2 minutes, right? But then 6 months down the line, you'll be able to do this stuff in your head. It becomes back of the napkin stuff, right? So a lot of new business owners, they can't talk about their incomes. They can't talk because they don't know. They haven't sat down to do the math, to do the tedious work that it takes to get there. And once you do it, the more you write, the more fluent you get. And eventually this stuff becomes easy. And when this stuff becomes easy, then you can focus on your people, you can focus on your clients, you can focus on your vendors, and you can focus on the business. So that's why, you know, having a good accountant on board, but also knowing enough to ask educated questions, right? So you want to maybe hiring someone to do the job is the way to go, but you must know enough to ask educated questions so that you can serve your business and that they are serving you appropriately.
Thank you. Therein lies the hope, right, of understanding this, what could be complex, but really, I thank you for your slideshow, and you all will get a copy of that. And so just take the time to look over the glossary of terms, and just get to familiarize yourself with the language and understanding it, because I think that that is so important. Understanding it, you know, that's financial literacy, and it's really important for the integrity of the business, the health of a business, and then the health of the community and the people as well. So thank you so much. Did you came on camera, Edward? Did you have a question or a comment, or you're just wanting to say hi? Oh, okay. Didn't mean to call you out.
You're still muted. You're muted, Edward.
He's like, whoa. Is there any? Oh,
Edward, you're muted. We can see you laugh, but we cannot hear it.
There, can you hear me now?
Yeah,
Yeah.
yeah, we can hear it.
I was just explaining. Yeah, you caught me. I was just about to leave the room, and I was just saying thank you so much. Thank you, Raymond. Thank you, Michelle. I really enjoyed it. I'm actually an accounting student, so I get a lot out of these still. They're good reviews. So, you know, I'm at that stage where I'm intermediate, working on intermediate accounting stuff. So
Good
my next
stuff.
courses are advanced. So like I said, so this helps a lot for the refresher. So I just wanted to say thank you again. And yes, you did catch me leaving. Thank you, Raymond. Thank you, Michelle.
take care, Edward.
And then my last thing that I wanted to touch on when we were talking about it only works in practice. So what I would suggest, if anyone's actually like, you know, running a business or taking it, is to go back and look at what you're currently doing and just compare it to the big slides that had the whole statement, cash flow, balance sheet, income statement. Compare it to those big slides and simplify it as much as possible. And you should just be able to see it, right? And those 3 documents, if you can, you know, print it off once a month or once a quarter or whatever, ideally in the beginning a month, right? Because you're just learning it. But once you're, you know, seasoned quarterly, but that's your snapshot. That's your numbers snapshot of your business, right? And once you get fluent at that, the rest of it's a cakewalk.
Awesome. Well, thank you all. Any last questions? Thank you all for joining us. Really good conversation, really good questions. Thank you, Raymond and Monica, for joining us this afternoon. Really good information. So we hope to see you back again for our links to learning. Have a good rest of your afternoon. May you walk with peace and love and wisdom and courage and truth and honesty. May you walk with Creator. Aye, aye.
Great.